Good morning and welcome to TOITOI Japan Market Radio for Friday, January 10, 2026. I'm your host speaking to you from Tokyo, bringing you the essential market intelligence that global investors tracking Japan need to know. Today we have quite an interesting setup because the Japanese market was actually closed for a holiday, yet there's plenty to discuss in terms of positioning and news flow that will matter when markets reopen. Joining me as always is our portfolio manager who focuses on Japan macro. Let's dive straight in. What's the overall picture for Japan heading into the weekend?
Thanks for having me. So yes, Japanese markets were closed today for a public holiday, which means no live price action in the Nikkei 225, TOPIX, or JGB futures. However, the backdrop heading into the closure was quite constructive. The yen had been sliding versus the dollar, and the Nikkei 225 was nearing record highs in the previous session. That's an important setup because it tells us that global investors are still bullish on Japanese equities, even as the currency weakens. We also saw some corporate news and geopolitical headlines circulating today that will likely influence sentiment when Tokyo reopens on Monday. So there's a lot to unpack despite the holiday.
Understood. Let's start with that currency and equity dynamic you mentioned. We've been seeing the yen weaken against the dollar while the Nikkei approaches record territory. For global investors who maybe haven't been following Japan closely, why does that combination matter so much?
It's a classic Japan trade setup. A weaker yen is typically a tailwind for Japanese exporters. Think about the automakers, the electronics giants, machinery companies. All of them benefit from improved price competitiveness abroad, and they get a boost when they convert those foreign revenues back into yen. So that supports earnings expectations and equity valuations. At the same time, the yen slide reflects the market's view that interest rate differentials between Japan and the United States will remain wide, meaning the Bank of Japan is still seen as being behind the Federal Reserve in terms of policy tightening. That keeps the dollar bid against the yen. Now, the risk here is that a persistently weak yen also raises import costs, especially for energy and raw materials, and that can stoke inflation. If inflation pressures return, the BOJ might be forced to tighten faster than markets expect, which would be a curveball.
So it's supportive for equities in the near term, but there are some medium-term policy risks to watch. What does that mean practically for positioning in Japanese equities right now?
Right now, the momentum is constructive. The Nikkei and TOPIX have been well supported, particularly in export-heavy sectors and cyclicals. For global investors, that means if you're long Japanese equities, especially in the industrials or tech hardware space, you're benefiting from both earnings upside and multiple expansion. However, I would keep an eye on valuations. When you're near record highs, it's worth asking whether the market is pricing in too much optimism. And on the FX side, if we see USD, JPY push above the 145 to 150 range and stay there, that's when inflation concerns could start to creep back in. JGB yields might face some upward pressure in that scenario, though Japan's structural deflationary backdrop means moves will likely be modest.
That makes sense. Now, shifting to corporate news, there's been some interesting commentary around Mitsubishi UFJ Financial Group. An article surfaced asking whether MUFG, Japan's largest bank by assets, might be an undervalued opportunity, essentially framing it as a potential sleeper power play. What's your take on that thesis?
It's an intriguing angle. MUFG is a systemically important financial institution and a core holding in the Nikkei 225 and TOPIX, so its valuation matters not just for bank investors but for anyone with broad Japan equity exposure. The argument here is that the market may be underpricing MUFG's strategic value and earnings potential, particularly given its substantial domestic and international operations. If that thesis gains traction, you could see a rotation into financials within the Japanese market, which would support the broader indices given the weight of banks in the benchmarks. Financials have historically traded at discounts in Japan compared to global peers, so if sentiment shifts and investors start to re-rate the sector, that could be a meaningful driver.
And what would that mean for the broader market, not just for bank stocks, but for the yen and yields as well?
On equities, a rally in financials would likely be supportive for the Nikkei and TOPIX, especially if it reflects improved confidence in Japan's financial sector stability and earnings outlook. It could also signal that investors are becoming more constructive on domestic cyclicals, which is a positive for overall market sentiment. On the FX side, if Japanese bank stocks strengthen and risk appetite improves, you might see modest yen weakness as safe haven demand eases. Investors would be rotating out of defensive positions and into growth and cyclical trades. As for JGB yields, the direct impact is limited, but stronger equity markets and improved economic sentiment could put some modest upward pressure on yields, particularly if it reduces expectations for further BOJ accommodation.
So a potential positive catalyst for Japanese equities, particularly in the financial space. Meanwhile, there's another theme we need to discuss, and it's coming from outside Japan. Asia-Pacific markets are positioned for a lower open following some comments from US President Trump that have rattled defense sector stocks globally, and we've also seen oil prices slide. How does that dynamic affect Japan specifically?
This is a risk-off setup that could weigh on Japanese equities when markets reopen. Japan has material exposure to both of these factors. First, on the defense side, Japanese contractors like Mitsubishi Heavy Industries and Kawasaki Heavy are significant players in the regional security landscape, and they benefit from elevated defense spending in Asia. If Trump's comments create uncertainty around U.S. defense commitments or spending plans, that introduces headline risk for these names, and you could see near-term weakness in the aerospace and defense sector within the Nikkei. On the oil side, lower crude prices are actually a modest positive for Japan because the country is a net energy importer. Lower oil reduces input costs for manufacturers and refiners, and it helps the trade balance. However, it also reduces inflation pressures, which might delay any BOJ tightening expectations.
So there's a bit of a tug of war here between the negative sentiment from defense and the positive from lower energy costs. What's the net effect likely to be for the Nikkei and TOPIX?
In the near term, I'd expect some weakness, especially if global risk sentiment deteriorates further. Defense and aerospace names could drag on the indices, and if broader risk-off sentiment takes hold, you'll see selling across cyclicals and export-heavy sectors. That said, the oil price decline does provide some offsetting support, particularly for companies with high energy input costs, think chemicals, transportation, utilities. So it's not a uniform negative. On the FX side, risk-off conditions typically support the yen as a safe haven currency, so you might see USD, JPY pull back a bit. Lower oil prices also reduce Japan's import bill, which is structurally supportive for the yen over time. And for JGB yields, if we do get an equity sell-off, you'd expect yields to trend lower as investors seek safe haven duration. Lower commodity prices would also dampen near-term inflation expectations, which supports JGB demand.
So the magnitude of Trump's rhetoric and the depth of the oil price move will be key variables to watch. Given all of this, currency weakness supporting exporters, the MUFG re-rating story, and now the risk-off setup from defense and oil. What's the main takeaway for global investors tracking Japan right now?
The main takeaway is that Japan remains in a constructive equity setup, but we're entering a period where volatility could pick up. The yen's weakness has been a tailwind for exporters, and that's helped push the Nikkei toward record highs, but we're now at levels where valuations matter and where any shift in BOJ policy expectations or inflation dynamics could change the picture quickly. The MUFG story is interesting because it highlights that there may still be pockets of value in Japanese large caps, particularly in financials, which have been under-owned and underappreciated. But the risk-off tone from defense and energy introduces near-term headwinds, so I'd be selective. Focus on quality exporters with pricing power, keep an eye on the yen for signs of a reversal, and watch JGB yields for any signal that the BOJ's timeline might be shifting.
That's a very clear framework. So for listeners, the key themes are the currency-equity relationship, the potential for a financials re-rating, and the crosscurrents from global risk sentiment affecting defense and energy. We'll be watching how these play out when Tokyo markets reopen on Monday. If you're a global investor following Japan or managing exposure to Japanese equities, this is the kind of daily intelligence we bring you on TOITOI Japan Market Radio. Consider subscribing so you don't miss the next briefing. Thanks for joining us today.
Thanks for having me.
And that's it for today's show. We'll be back with you next time with more market insights from Tokyo.